Tariffs continue to be an overhang on the market as we head into the weekend and as we head into the important April 2nd date next week when they all start, especially with the additional tariffs that we heard this week announced on automobiles, foreign automobiles. It's still having its impact, but today you also had inflation data coming out and you had consumer sentiment data. Continues to show that even though prices may be rising slightly, it doesn't look like it's being largely driven by strong consumer demand. It looks like sentiments, we've already known sentiment's really been dropping off like a rock in the stock market, but they're dropping off right now too from a consumer standpoint again. So we'll break down kind of how that's impacting the stock market, how that's impacting different asset classes. There's a shift from how they were impacted in 2022 to how they're impacted now. Which is a difference between an inflationary environment and probably more of a deflationary environment. When I say that, I don't mean necessarily that inflation, that prices are dropping, more so that yields are dropping. So we'll take a look at that. We'll take a look at pretty much the last signs that suggest that we are in correction. So what does that mean? What does that terminology mean? We've already dropped 10%, so that means we're done? Like, we get all these signs that correction is starting, but we've already dropped 10%, so are we done now? Because that's what corrections are. They're 10% decline. So we'll break that down and what it means and what we can expect if we are indeed in correction. We'll break that down. And then we'll take a look at our trade idea again in the retail sector. That's, the retail space has been getting hammered, and this stock got hammered last night. So we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, March 28th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. You hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So kind of took a drop off here down to 28 after hitting 60 on the last one. So let's see if we can't over the weekend get back up to over 60 again, maybe even get up to 70 on the next one. Thank you to those who do this day in and day out. It means a lot. It goes a long way for us. That's why we always ask. So if again, you can do it with one or two really easy clicks while you're watching the video. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. So you can see dark pink shading and a red line again. The red line's been there the whole time, but we went from light green back to dark pink because of the drop in the intermediate line. It's already below 50, so it goes straight to dark pink there. The short-term sentiment is pretty bearish. The momentum line dropping down to extreme lows. The near-term line into reversal zone, so relatively bearish. Again, it doesn't usually, like the momentum line now has stayed down there for 3 days, down and again to extreme low. So again, barring a big drop, which, again, I don't think necessarily that we're starting a big drop here. I think we're still kind of ending this one. I think it's more likely next week that we bounce off of this. I think we're probably going to get I know Tom Lee has talked about that we're going to bounce off once we get the April 2nd news. We'll start to really take off to the upside, and I think he's kind of anticipating like a huge move to the end of the year, as he always does every year. And this is the low of the year. I still think that this is probably the high of the year that we have here in February. And I would love to be wrong in that case because almost all of us are bullish in our long-term portfolios. So I would love to be wrong, but I think that's probably the high of the year. And but I don't think that this is. I think that we're still have an explosive move coming off of a low point in this area. We didn't get it here. That was a pretty decent move, but it wasn't nearly explosive. I think one's still coming that will really sucker people into thinking that we are going up to go to new highs. And I think it will happen really as early as next week. Potentially even with a bullish day on Monday, because Mondays tend to be. Last Monday was a really bullish day here, so we'll see if that ends up being the case. Coming off of relatively bearish short-term sentiment, the near-term line, of course, crossed below. We saw that yesterday. The intermediate line. The Nasdaq 100 looks very similar. It was actually down more, so your short-term sentiment was even more bearish. But again, hasn't gotten to new lows yet, and we'll see if that ends up happening here next week before the actual April 2nd takes place. The Russell 2000, which has been in correction mode already, is showing a very similar pattern as well. Near-term line crossing the intermediate line, going into bearish territory. And then finally your Dow Jones Industrial Average. Oops, Dow Jones. And if I can type here. Dow Jones Industrial Average, you can see it's at bearish levels. Again, very similar, dark pink shading and a red line. But let's take a look at the weekly chart, because this is where it really kind of stands out here. Because again, when you get a bull tag and it leads to dark pink shading and a red line, we're in a pullback mode on the daily chart. On the weekly chart, when we get a bull tag and it leads to dark pink shading and a red line, we're going to correction mode. And again, what is a correction? And I just barely here after the market close tweeted this out, so I'll bring this over so you can see it here. A correction isn't just simply a 10% drop. There's a lot more nuance to it than that. A correction is an extended run below the 200-day moving average, no matter how big the drop is. So for an example, the last 6 corrections, here is how long they stayed below the moving average and how far below it they got at the lowest point. So on average, a correction spends 110 days below the 200-day moving average and bottoms out an average of 15% below it. Currently, we've only spent 13 days below the 200-day moving average, and we bottomed out only 3%, 3 2/3 below it. So when I look at this chart and say, okay, let me zoom out so we can see like all the last 6 corrections. You can see them very easily here. A bull tag that leads to dark pink shading and a red line. A bull tag that leads to, in this case, dark pink shading and a red line pretty temporarily because COVID was so fast, right? Over here, 2018, a bull tag that leads to dark pink shading and a red line, and goes pretty decently below that. This one went pretty decently below. This one went pretty decently below. A bull tag in early 2018 did not lead to dark pink shading and a red line, and just led to a new move to the upside. Okay, a bull tag here in 2016 around the election again did not lead to dark pink shading and a red line, led to a bounce up to the upside. Here, a bull tag led to dark pink shading and a red line. Look how far below it we got. That's 15 and 16. You can see a couple of bear tags there, bull tags that did not lead to that. A couple others here also did not lead to dark pink shading and a red line. 2011 did. Look how far down below we got. In this case, we were 13% below the 30-week moving average. Well, right now, we are less than 5% below. Pretty similar to what we were in 2000 over here. Just barely less than 5% below. Did not lead to dark pink shading and a red line. But, and obviously in some of these other instances like 2022, we bottomed out over here at 15.8% below. And then again later in the year at 12% below. So at 5%, again, look at it relative to other corrections, we are not in correction, right? We are actually probably a lot closer to 2023 than not. Even though we have dark pink shading and red line, the intermediate line barely missed dropping below 50 in 2023. Well, it has dropped below 50 here. So, and you notice again the intermediate lines bearish. Down here the momentum lines extreme lows. But then if I look at like the monthly chart, which we have one more day left in the month here on the S&P 500, you look at the monthly chart and we're nowhere near a bull tag. So on the monthly chart, a bull tag here, if it leads to dark pink shading and red line, leads to a bear market, right? A bull tag is the low point of the correction. So to get a bull tag, you have to be below the 30-month moving average. We're nowhere near the low point of a correction right now. So if we are in a correction, we are in infancy stages of a correction. 13 days below the 200-day, and the average is 110. We have a long ways to go before we bottom, and we have a long ways to go down before we get the bottom being significantly below the moving averages. So no, I would say we're not in a correction right now, and we may be starting one, but we are definitely not in one. And then what we're still missing is that tremendous move. And again, why does it matter? Because again, if we are indeed in correction, we've got 100 more days to go below the 200-day moving average, and we got a long ways to go lower. Like it's not just simply 10%. Oh, 10% we're in correction. No, if you told me right now we're in correction, then I'm expecting we're going to be below this 200-day moving average for months, for weeks to months. And it's going to be months to get back up to new highs. It's going to take a long time. And we still got a lot more downward move to go. I think 4,600 right now is where the 200-week moving average is. That's way down here. Now it might be up higher by the time we get there because it's moving up. But that's a long ways away to the downside if we are indeed in correction. And again, the correction doesn't start until after you get that first green tag. Now, is this that first green tag? Very well could be. 4.6% is how high we got. You need 5% to actually get a green tag. So I don't think we're there yet. I still think we're flushing out the low point. We might, there might be 10.13% by the time we're done. It might be 11 or 12% by the time we're done. And then again, we need an explosive move off that low to sucker people into thinking that we're going up to new highs. Because that's what makes a correction so bearish, is that you have a lot of people that are suckered in at this point when they shouldn't be, to thinking, oh, okay, back up the truck and let's go. Instead of, like the professionals, when they see this decline, they see all the other signals we've been talking about. What they're looking for that green tag is a way to get out, right? A way to start lightening up positions and start unwinding trades that have been working for them, to start lowering their weightings or overweightings they have in certain areas and putting that overweight in other areas. That's what they use the green tag for. So the smart money is using it to get out, whereas the less than smart money thinks, hey, we're going up to new highs. And again, when we fail and break, that's why it ends up being so bad, because the smart money is already out of it, right? And now the less so smart money is starting to get out of it, and they exacerbate a selling to as far down as we ultimately get to during a correction. Again, last time we saw that was 2022. So that's kind of where we're at right now. Again, with the weekly market forecast showing dark pink shading and a red line for the first week. So basically saying we very well, and I think we will, because you notice on the monthly chart we're getting a bullish intermediate confirmation signal. So there's a very good chance that April ends up being at worst a small down month, at best probably a small up month. I don't think we're going to bounce up a lot. So we'll probably get a little bit of a bounce up in April. So it won't be that bad, right? So that will probably be what drives our 5% tag to the upside. It very well could happen as soon as we get through the April 2nd. It might end up being a kind of, in this case, a sell the rumor and then buy back the news event with the tariffs that are coming out or starting next week. So that's the market forecast chart. Some of the other weekly charts you can see, again, 3 straight weeks now. We only spent 1 week below the 200-week moving average over here. We've had 3 straight weeks of being below the 40-week exponential moving average. Again, that's not necessarily the best sign in terms of it just being a pullback, right? Looking at the Hull moving average, sometimes we look at this weekly Hull. The daily Hull is turning back to being bearish. The parabolic SARs flip back up to the upside. And we haven't turned green yet, but we're pretty decently below the 200-day Hull, so it's kind of hard to really start a new big leg to the downside here. So that's why I don't think we're doing that. We haven't had enough of a rally to start a new leg lower, in my opinion. If I look now at the weekly chart, again, you can see we have now dipped below the 5% mark. That's a key level. We are finishing below 5%, more than 5% below the 200-week Hull moving average. Obviously your 20-week is red, and we got the parabolic SARs, but again, we can move up quite a bit here and not flip the parabolic SAR back down to the downside. So there still is plenty of room for there to be a failed rally and not change the trend. If I take a look at the 3 green arrow charts, again, you can see we don't have 3 greens, and we're almost back to having 3 reds, and MACD is the only one that we're missing on this. If I take a look at the 3-week moving average, again, we have 3 red arrows and now a red line. Okay, that's kind of the idea behind the market forecast. So the moving average is turning lower. So we have 3 red arrows. One thing to get 3 red arrows and not a red line, but it's the same thing with that bull tag on the market forecast. Once you get 3 red arrows and a red line, like we had in March here, we are susceptible. Like over here, you have to have a good long period of green, but here we had a correction. Here we had a correction, no correction, no correction. Here we had a correction, no correction because no red line, right? No correction there, correction over here, no correction on these 3 red arrow signals, no correction on these 3 red arrow signals, but a correction here. So it's the same idea. Well, now we have, again, multiple weeks in a row, so it's more than just 1 or 2 of 3 red arrows, and it's 4 now, actually. 1 or 2 is okay, right? We can get away with 1 or 2, and then we turn right back up, and then we can avoid it. But we've had 4 now, and now, you know, it's pretty clear that, again, this is more than just a little bit of a pullback. If I take a look at some of these other oscillators, like the DMI, again, we are back above 30 in the negative indicator, below 20, so the ADX is starting to turn back up again. We got the dark pink shading down there. If I look at the RSI and the CCI, they're still at bearish levels, back below 40, back below 0 on the CCI. Looking at the, and again, remember the weekly CCI is dropped below minus 100, hence, you know, again, the correction level type drop. If I take a look at the Ichimoku cloud, again, correction level type strength on this bearish move. It's big bullish move here, and the relative strength is clearly bearish, and it's looking like it's going to be really hard to get above the cloud by the time it turns pink, and really hard for this to get through, you know, this initial decline. You know, most likely we'll end up below this low point by the time we actually get 26 days away. Again, looking at the weekly version of this, we ended the big bullish move that we have, and usually when you end a very long, very mature bullish run, you know, that typically is more than just your garden variety pullback. There usually ends up leading into correction. You can see the 26-week rate of change, which is a 6-month rate of change, has turned clearly negative, and it doesn't do that either on just your typical pullbacks. It's, you know, clearly negative now, more than it was when it was slightly negative in October of 2023. If I take a look at the Bollinger Bands and the Keltner channels, you can see, again, we're in the lowest quartile of the bandwidth. The bandwidth, though, is falling. So, again, that's why I don't think we're starting a new leg lower. We haven't broken out of the bandwidth. We haven't broken out of the Keltner channels. The bandwidth's not rolling up. It's actually still pretty darn high. So I still think there's still some consolidation here left. I don't think there's very much more downside. We might go down a day or two tomorrow, next week early. I don't think there's as much downside next week as what we've seen the last 3 days here, especially over the last 3 days. In fact, when you we'll take a look at the sector move here in just a minute. Looking at the intraday chart, you can see lower high and a lower low, closing below last week's low point after opening above last week's high point with a gap up here on Monday. We ended up closing below last week's low point. We did not, however, get a new 4-week low, so that's good, right? No 4-week low. The momentum lines, or the red line on the rune, still way down here now below the 50th percentile. The green line still is here at 0, and it still will be, right? Because the high point will just keep kind of dropping. But with the high point dropping and the lows not really dropping themselves, the range is really starting to drop back down. So that's a good sign. Easier to break out of a smaller range to the upside in this case. Easier to do that in a smaller range than this bigger range. So it's actually a positive working in our favor for the markets there. If you take a look at today's volume and trading range, they picked back up again. Whoops, let's go to this one. They did pick back up again. So today's range was over 11 points. The volume is over 71 million shares. So again, put those numbers into context, and you can see both those numbers are moving back up, right? At least that one is, the normalized ATR. And even if we were to rally, again, the first few days of that explosive rally, even if it fails, should be pretty large days. So the normalized ATR actually still goes up typically after we hit the low point. And that didn't really happen over here. It actually started going down already. So again, another sign that rally wasn't explosive enough to be considered a failed pullback bounce. You can see the volume still very, very high, relatively speaking, relative to the range of the last 52 weeks for that average. And then finally, the VIX jumped up today, not surprising, back above 21. We did not jump back above 100%, so that's a small positive working in our favor. We did jump back up pretty considerably above 100, so we had been below 80 even. We got to, where did we ultimately get to on this? On the VVIX, I think we dropped close to 80, 81. So well below 90. But now, again, big jump today, again, suggesting some volatility going into next week. But the VIX really isn't confirming that. And the VIX is up relative to its average values here, kind of holding that 200-day. I think we still make another run back to that 200-day as we make that run to the upside, to that bear tag on the S&P and on the market forecast, and to that 5% green tag on the zigzag. So we are breaking back out above averages. So there's an opportunity we can really take off. I don't necessarily think so. I think next week will end up being more of a buy back the news, sell the rumor kind of event by the end of the week. Maybe not Monday and Tuesday, but by the end of the week. I think that's what will end up being the case. All right, now let's talk about what's driving this price action here today. And it continues, the big talk obviously continues to be the tariff news and the impact it's having. It's having a positive impact on gold, a negative impact on the dollar, and really a positive impact on both bonds, whether it's global bonds here or U.S. long-term treasuries and gold. So safety trades, and the dollar is down, but it's actually up against all these different equity asset classes. If I look at the past 3 days that we've had these declines, again, look at gold doing very well, and bonds started off weak and then had a big rally here today. And then, of course, like I said, the dollar has been relatively flat, but again, outperforming most of these other. In fact, you can see high-yield bonds really underperforming, outperforming treasuries for the first 2 days here, but then underperforming big time here today. So clearly a big shift into safety trades as we got PCE coming out stronger than expected, so inflation's still an issue. The consumer sentiment survey was weaker than expected, so that's still an issue. Here is the 10-year yield on a 1-year chart. Let's just go to the TNX. The 10-year, look at that big drop we had today on the 10-year yield. And we talked yesterday about, there's probably not a whole lot more upside to this because it's right at the midpoint of the current Fed funds rate and has a lot more downside, especially if the 2-year yield continues to price in rate cuts. Well, we saw today down, 11 basis points there on the 10-year yield. And again, then that's despite the fact that inflation is actually was such stronger. Core PCE was actually stronger than expected. Here's the core PCE levels. You can see here, let's zoom in. Let's zoom out to the 5-year chart. And you can see, again, jumping back up to 2.8%, 2.778. Again, that's not the highest of the range, but we're also not continuing to drop. And that's, again, you would think that would have a positive impact on yields and the dollar for that matter as well. And like I said, the dollar rolling back over here to the downside. But it's actually having a negative impact on both of those two things. Again, University of Michigan consumer sentiment, for some reason, is not showing, even though it was updated here today, is only showing the February observation. The March observation went down even further. So, again, February was at 64.7. The March is down to 57. So, the lowest level that we've seen again since the end of 2022. So, consumer sentiment's rolling over, even though that inflation, you can see inflation expected to be up pretty decently high to the upside. So you would think again but that's not the case here. Like lately, the relationship between risk appetite and bonds, which has generally been positive, has not been the case. That hasn't been the case here lately. In fact, you can see it's a pretty strong negative correlation, especially when I go on a 3-month chart. It's been getting progressively more negative, which is kind of the norm as what it had been in the past. As TLT really ramping up and stocks dropping today. But also when you look at the dollar index, there's a pretty positive correlation between the two, and that's not normal. It's typically negative. And so when you look at bonds, or the dollar, and then compare that to bonds, both of them being relatively safety trades, but the dollar being kind of in line more positively correlated with the S&P bond yields. And you can see, look at that negative correlation that we've had for a very, very long time with the dollar and bonds prices themselves. But you can see it's been progressively getting less negative. It's been very negative for so long, but it's been progressively getting a little bit less negative. So when I go back to like just a regular 2-week correlation here between the two, you can see we've had a little spurt of it being relatively positive, where they've both been going down together, and it looks like they're both starting to work our way in that direction. Again, here's TLT. Pull up TLT on this chart here. And again, you can see kind of both of them moving down in the same direction. And then now the dollar's moving down and bonds are moving up. So kind of back to the normal negative correlation between the two. So all of that's kind of what's impacting here. Again, inflation is rising. And when we had this in 2022 with inflation rising in 2021, the dollar took off, bonds fell, stocks fell, but that's not the relationship we're getting this go around. The dollar is falling and bonds are rising and stocks are falling. The complete opposite of what we saw in 2022. We also see, again, a big drop in technology stocks, and that's our big concern, right? Because technology, that's our market leader. That's what we want. That's who we need to lead us up on the upside if we're going to maintain or get back to new highs. And the last 3 days, technology is down 5.5%, as well as XLY and XLC. The three sectors we do not need to be seeing lagging the market. They are lagging the market. And XLP, XLU, XLRE, those are the three sectors we don't want to be leading the markets, and they have been leading the markets. If I go all the way back to the low point that we had on March 14th, XOK is now back to being the worst performing sector since that low point. Even though the S&P itself is still 1% above the low, XOK is the only sector that's actually below where it was on March 14th. And you can see energy and financials outperforming, XOY really dropping down. And what had been lagging behind, they're starting to really ramp up in the past 3 days. So a clear shift to safety across the board, right? Across the board, there's been a clear shift to safety. Here is, let's go over here to the XOK on this chart. So let's pull this up here, and then we'll pull up just a regular, and pull up XOK. I mean, clearly down below these moving averages. You can see what had been, we were kind of moving up into the blue on the daily chart. We're starting to potentially roll back down to the left, and we're not really moving up very well yet on XLC, and all these other sectors which are moving down to the left, you appear to be rounding back out and moving back up and maintaining the longer term trend, which is clearly up to the right in a lot of these other sectors that we don't want to be moving up to the right, and clearly down to the left on these other sectors that we don't want to be moving down to the left. Here is XLK on the weekly version of this chart. Again, way down below. We are in correction mode according to how the technology sector is performing relative to itself, right? Relative to its long-term averages, and down here again, and both lines down there below 100. But when I look at it relative to, say, the stock market, the SPY, we'll just keep it ETF to ETF. It's a big drop there. If I were to go to the weekly version of this, go weekly. You can see a clear shift of getting below this week for the first time below the 200-week moving average. Now, we did close below it there at the end of 2022, at the lowest point of the correction. So it's kind of interesting here that we may be starting the correction with a break below the 200-week moving average. Right now, the correlation between this and the stock market itself, the SPX, is negative. But again, as you can see, that's not normal, and that you would expect that will turn back up. And the question is, will it turn back up with both the ratio and SPX going up, or will it turn back up with the ratio breaking to the downside as you would expect, and SPX turning down? You can see the long-term PPO still hasn't crossed below zero yet, working in that direction. But a clear shift, right? Let me zoom in so we can see it a little bit better on this chart. But a clear shift in sentiment and a clear shift in rotation. This is the first week. This is the first week since early 2023 that XLK relative to the S&P 500 is below its 200-week moving average. Again, it's a very low PPO. We most likely will bounce, so we most likely will probably bounce back up just like we did all these other weeks. But it, again, goes to show how things are changing in a big way. The breadth still is very poor. Looking at the number of stocks above the 50-day moving average, back below 200. We had made a brief run up above it. Number of stocks above the 200-day moving average stayed below 250 this whole time, but is back below its average and rolling back over. The number of new highs and new lows continuing to be relatively negative, minus 460. Let's see if that's the actual number here. We have 551 versus 91. So yeah, that's a big number. 460 net new lows. That's well below the average, well below minus 200. The breadth is clearly negative and moving up here, which is not what we want to see, to the upside, but not like spiking up, which is what washes out the low point. So we never had the washout there on that first low, and we might be moving in that direction on this current low here. Finally, looking at the McClellan oscillator, which is the last indicator we look at for breadth, and you can see again, but back below minus 35, and we're still below zero on the summation index. So clear change in breadth, back to being from weekly bullish back to being pretty clearly bearish on the trend that we're in right now, and clear shift to safety, right? Whether it's again gold, whether it's bonds, whether it's safety sectors, whether it's Bitcoin. Oh wait, not Bitcoin. Bitcoin is obviously, but remember how Bitcoin is supposed to act as a safety trade? Bitcoin is not acting as a safety trade, right? It is failing. It got to the 200-day moving average. It's bounced back up to the 30, and right now is failing at the 30-day moving average, and potentially going to make a run below the 200-day, which is extended run below the 200-day, which would be a correction. Which again, the first time Bitcoin has had a correction since 2022. The last time it had an extended run below the 200-day moving average. That's what corrections are. So we're again, that's not necessarily acting as a safety trade as much as it's been touted to be an alternative safety trade to, like, say, gold in the past, and definitely not acting as one now. All right, and that takes us to our trade idea of the day, and it's actually and again, the retail space, which is not doing very good, and Lululemon's the latest victim. Just had its earnings announcement. You can see the big breakdown it had there. Let's take a look at its market forecast. You can see the big breakdown that it had after trying to get above and almost getting to it did get to the moving average on an intraday basis before rolling back down. The near-term line coming back out of bullish territory, the intermediate line rolling over. So significant drop, down 14% below the moving average, which is, as you can see, not the lowest it's been. If I take a look at the weekly version, its weekly chart, obviously I got a bearish candle, but we're moving into death cross environment now, which last time we moved into death cross environment, we really went down for multiple weeks, down to 237. So things not looking so good for the stock. Obviously, we do not have three red arrows. The MACD has not turned red yet. The stochastics has turned red, and then obviously we're below the moving average. But we're also breaking the point of control, which is not just the 200-day moving average. We got to the 200. This is kind of what we were looking for the market to do. Get to the 200, bounce to the 30, fail, and then work your way back to new lows and below the 200-day moving average. That's what a correction is. We had already been in one for a long time. We tried to recover, and then just like that, we're headed towards another one on Lulu very quickly. So things not looking so good. That's why we're potentially in a death cross environment again on the stock, which is what you typically get during corrections, where you end up getting with the death cross environments there. Let's take a look at some of these other oscillators. They're obviously going to all be bearish. We're way above 30. We're above 40. Not quite below 20 yet on the positive indicator, but you can see working our way in that direction with the ADX already above 25, which means we typically get bigger moves while it's up there. Back below 40, well below 30 on the RSI, well below minus 100 on the CCI, so pretty clearly bearish there. The Ichimoku cloud. You can see we are well below the cloud. We're getting to the point now where it's pink and we're well below it. We're not crossing. We were looking to cross up above, right, through this line on the rate of change. We're already back below that low point, and we still got some time to get there, but big move down. We still have a very mature bearish trend. We can have one on an individual stock. We don't usually have one on the index for very long, but you can have one on the individual stock for a long time, and we could potentially be starting one again with the beginning of this death cross. And then finally, you can see we're obviously breaking below both the lower Bollinger Band to a large degree and the lower Keltner channel today, with the momentum having gotten pretty weak on the bearish side, starting to pick back up to the downside, and we have the bands had moved back inside the Keltner channels, looking potentially to make a move back outside of the kind of like what we did right here. Getting some bearish momentum, bands moving inside, and then we break back outside with a renewed leg lower to the downside. And that's obviously that's the potential that we have right now for a similar type move. So because of that, what I decided to do here was come over to the April options, which still are 20 days away, and do a long put vertical spread selling. You can see the 1 standard deviation move here is down to 2 by April to 265. So I sold the 270. Sold the 270, bought the 275 for protection. So you can see I position size for my typical $500 of risk, getting about a 3-to-1 reward to risk ratio if it continues to move in that direction. So there's our trade for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody. We'll see you all on Monday.